Good evening, everyone. I'm Christine Alton. I'm Professor in the School of Finance and Management here at SOAS, and it's my pleasure to welcome you all to the second Penrose Lecture 2023-24 by Professor Bill Lazonick, President of the Academic Industry Network and Emeritus Professor from the University of Massachusetts, among many other things. A special welcome to those of you joining online, including colleagues and previous students of Professor Lazonick from around the world. And I'm very pleased to welcome back some members of the Penrose family, Angela Penrose, Trevia Penrose, and Sephrin Penrose. Angela's Edith's daughter-in-law, Trevor's Edith's son, and Sephrin is Edith's granddaughter, who's also a SOAS alumni, so it's really nice to have you back here with us tonight. Now, I should say that Angela, if you've not seen it, has written Edith Penrose's biography, No Ordinary Woman, The Life of Edith Penrose, published by Oxford University Press. And I would highly recommend it. It provides a wonderful insight into Edith's life and work. The Penrose Lectures were established at SOAS after the conference to celebrate her centenary year. And 2 lectures are delivered each year on a subject in management, economics, or political economy. Edith Penrose's work has left a lasting legacy. We heard yesterday from Antonio about economics, impact on economics, and not just one, but 2 disciplines. In fact, in some ways, her legacy might be greater in the field of management than economics. From her pioneering research on innovation, patents, firm growth, and economic development to her analysis of oil companies and the economics of the Middle East, Penrose transformed the disciplines of economics and management. And that's a very hard thing to do, to have such a big impact on not just one discipline, but 2. And she analysed them from a truly international perspective, an approach that we continue here at SOAS to take forward today. Of course, she's best known for her book, The Theory of the Growth of the Firm, published shortly before she joined SOAS in 1960, which has had enormous impact on the field of strategic management, inspiring, among other things, a resource-based view of the firm and the dynamic capabilities approach. Now, the book had its roots in a case study Edith completed on the Hercules Powder Company. So unlike much of economic theories we heard yesterday from Bill's first lecture, it was based on studying what actually goes on inside firms, rather than thinking of them purely in the abstract and trying to find a representative firm without any detail about individual firms. Few economists have adopted this approach, but we're fortunate that one who has, Professor Bill Lazonick, is here with us tonight. Those of you here yesterday will have been treated to his theory of the innovative enterprise and his critique of Samuelson. I should just say that I first met Bill in 1995 or 96 at a European Association of Industrial Economics conference. So I was giving a paper and I put up a diagram that I'd taken from his book, Business Organization and the Myth of the Market Economy. Fortunately, I'd acknowledged the diagram on the slide appropriately. And I did notice that there was this sort of strange reaction in the audience when I put up that, and Bill had a smile on his face. Of course, I had no idea that that was Bill Lazonick. I'd never met him before. It was a European conference. I wasn't expecting someone from the US to be there. I think he was probably just as surprised to see his diagram in a 20-minute presentation at the conference as well. But that was the start of when we got to know each other, and it's been a pleasure working with him on various issues ever since. In terms of his career, Bill completed his PhD at Harvard, which was later published by Harvard University Press as Competitive Advantage on the Shop Floor. And he started his career there as an assistant, then associate professor, before taking up a full tenured professorship at Barnard College in 1985, and then moving to a chair at the University of Massachusetts in 1993, where he worked with Mike Best and other colleagues. It would take a while to mention all Bill's publications. There are so many, but I guess ones that stand out are Business Organization, The Myth of the Market Economy, published in 1991, along with Sustainable Prosperity in the New Economy, which was awarded the Schumpeter Prize in 2010. More recently, his work on financialization has gained recognition And it does tie in with his theory of the innovative enterprise, or why we might not have innovative enterprise. In the past few years, he's published Investing in Innovation, Confronting Predatory Value Extraction, US Corporation, Predatory Value Extraction, how the looting of business corporation became the norm, and how sustainable prosperity can be restored, as well as from financialization to innovation in big UK pharma. That's a pretty impressive list, and that's really just the tip of the iceberg. So without further ado, I invite Professor Bill Lazonick to give his second Penrose lecture, How Edith Penrose Exposes Friedman. Please join me in welcoming to.
Well, thank you, Christine. Okay, so again, as I started yesterday with this, the title of the two lectures is making big claims about obliterating neoclassical firm. I think I did that yesterday. Now I'm making a claim that if we actually have a theory of innovative enterprise and we take it seriously, not just as a theory, but as a way of studying reality and integrating what I come to at the end of today, his history and theory, which is something that I think Edith Penrose did, that we could have a revolution in the foundations of economic analysis. Maybe you'll agree with me, maybe you won't. Okay, now the way I presented this yesterday was that it wasn't really Edith Penrose who was embarrassing Samuelson and Friedman. It was me using Edith Penrose to embarrass Samuelson and Friedman. And I had done the job on Samuelson, so Paul disappears from the picture, and now we'll do a job on Milton Friedman. Okay, now, before we get to Friedman, I want to say that when I often use this term sustainable prosperity in books and titles, what I mean by that is macroeconomic objectives of stable and equitable economic growth, which I'm going to define here in terms of productivity growth, employment stability over a lifetime, and equitable distribution of the gains of growth, not only now, but even across generations, if we think of the planet's resources. There's a very broad definition. I'm not sure I would get that much debate from any economists about those as being macroeconomic objectives, except that Chicago economists might say that if you try to pursue the second and third, stable growth and equitable growth, you won't get economic growth. And so that is a big difference, because I think that those three things can go together if you have innovative enterprise, if you have growth and productivity that is generating higher quality, lower cost products. You can just call it productivity. You can call it a theory of productive enterprise. But that is possible. Now, if we look at the U.S. economy, and certainly looking at Samuelson and Friedman, I'm looking primarily at the U.S. economy and how they interpret it, and also the fact that at least in my generation of being educated, certainly the dominant economics was coming out of the United States. You can see that the United States over the last 4 or 5 decades has not had stable and equitable growth. There's been growth, but it hasn't been stable and equitable, and often the growth is weak and fragile. And this is the Gini coefficient from the late 40s until I think 2022. And basically in the post-World War II decades, you've got what I call a retain and reinvest regime in corporations. They were retaining people, reinvesting the profits, sharing the gains with their employees, and you got somewhat more equality. I often call it, and I'll come back to this, a white man's world, because it was really one where the gains were shared with white men in corporations. But it did lay a basis for at least the Gini coefficient slightly declining over those decades. But then it changed. And I attribute that change ultimately to a whole new regime of corporate governance, which was to maximize shareholder value, which I'll argue today comes out of what I was talking about yesterday, that the most unproductive firm is the foundation of the most efficient economy. That's the starting point. for people to argue maximizing shareholder value, except now they are actually applying it to the economy and saying this is exactly what the economy should do. And as we'll see, that's where Milton Friedman comes in. This is another picture that came from David Leonhardt in New York Times using Piketty and Say's data. This is showing percentiles of the income distribution and how they changed between 1946 and 1980. You can see the gray line there. Lower levels of income got more gains than higher levels of income. And then between 1980 and 2014, totally different picture, and a huge concentration of income at the top. And economists who talk about skill bias, technical change, and that stuff, they can't come close to explaining that. The only way you can explain that is, I would argue, is through corporate financialization, the pumping of money out of corporations into the hands of a few. And that's what's been going on in the name of maximizing shareholder value over the last 4 decades. This is another picture also from the Piketty and Say's data. This is tax data from the US, which I started using long before Piketty became famous with his book. And this, unfortunately, only have the data in this form to 2011, but it shows the picture here that one of the ways in which the gains are being concentrated in the top is what's called salaries. That's actually mostly those peaks, and the big blue part at the bottom, the light blue part is stock-based pay. There's capital gains there, et cetera, but actually salaries and the stock-based pay that it's part of, not salaries. It's not really salaries. It's total compensation. There is something called the salary. Is actually not taxed at the capital gain, so it's taxed at ordinary income. But that's now. This is a picture that comes from the Economic Policy Institute, which looks at changes, percentage changes over time in real hourly compensation compared to productivity growth, and they track each other. In the post-World War II decades, the same kind of picture, a widening of that wages fall behind productivity growth, starting somewhere in the late 1980s. And although the Economic Policy Institute, if you know about that, they have rigorously over the decades, even though I once actually paid my own way to go to talk to them about stock buybacks, avoided any discussion of financialization. They do talk about executive pay, but not the financialization of the corporation, which I'll talk about a lot today. But that gap, which kind of struck me as looking like an alligator opening his mouth, so I stuck an alligator in there, is the place where the predators play. And as Christine said, Jangsup Shin and I in 2020 wrote a book called Predatory Value Extraction. And I'll show you a slide on that and very briefly how they play that game. But again, you get the same picture. Post-World War II decades, there is a different corporate allocation regime than you have in the last 40 years. And it's very marked by the rise of the notion that companies should maximize shareholder value. Okay, now, in terms of the micro foundations of the theory of innovative enterprise, which I talked about yesterday, which I'm not going to go through, but really when you look at the society as a whole, what you're talking about is we need to have high standards of living, spread it among the population, investment in productive capabilities. So the much bigger picture than what I'm going to talk about today, and I'll just mention this just so you're aware of it, is that there are organizations in the economy which in different ways invest in productive capabilities. Household units investing in the future labor force, government agencies operating as development states, investing in infrastructure knowledge. And by the way, the United States has the most formidable developmental state in history. And business corporations that then take those capabilities invested in by household units. In the US, it would be about 100 million or 70 million probably with children, and business corporations and government agencies, and they turn those into higher quality, lower cost products. At least that's what they need to do if we want to get higher standards of living. So they're engaged in value creating processes. And so we go from the triad to innovation to productivity, And then we need to have the interaction of these organizations to develop and utilize productive resources to generate high quality, low cost goods and services. That's what the economy is about. Now, laid against that is what I call the myth of the market economy. It's part of the title of the book that I wrote in 1991. Where basically argue that developed markets are outcomes, they are not causes of economic development. So we have developed product markets because firms have developed products and they're competing in terms of quality and costs in selling those products. We have developed labor markets because firms as employers offer jobs. Those markets are not there at developed markets if you don't have firms that can offer jobs, and the more sustainable the jobs are, the more they create new jobs, the more developed the markets can be. We have developed financial markets because firms as producers invest in productive capabilities, generate higher quality, lower cost products. They need finance, and insofar as they can generate profits on that finance, they can in fact afford the finance. Although, as I argue in the theory of innovative enterprise, and in reality, the most important finance is the money that corporations that make profits retain within the business organization. So it's not really even the market working there. But markets are outcomes, not causes of economic development. So when, as economists, we think about the economy, we have to start by thinking about organizations, not markets. And from this point of view, and this relates to what I talked about yesterday, the most unproductive firm is the foundation of the most efficient economy, which is an absurdity. Market imperfections is a meaningless concept, actually even an absurd concept. If someone says to me, oh, there's market imperfections, I say, well, you're not going to understand the economy if you think that it's market imperfections, because whether you know it or not, you're saying that some perfect market is some ideal. And this just permeates the discussion even about people who try to understand reality of it's all a market imperfection, or a more liberal view is also when something doesn't work, it's a market failure. I would argue more often than not, it's an organizational failure. The organizations haven't worked. Okay, and what do organizations do? And this is the link with Edith Penrose, which I talked about yesterday. They invest in learning, collective and cumulative learning. And with the confronting uncertainty, with the hope of generating higher quality, lower cost goods and services as competitors. And that's basically what I try to understand with the theory of innovative enterprise. Now, it's not just an intellectual debate. Actually, I wish it was an intellectual debate, because it's not even that. So maybe with what I'm talking about today, the intellectual debate can start, because it is not there among economists. So that's part of the problem. But it isn't just that, although that relates to it, that the neoclassical fallacy, this absurdity that the most unproductive firm is the foundation of the most efficient economy, is actually underpins the practice of shareholder value. Okay, the notion that if you allocate resources through the financial markets, you're going to get the most efficiency is based on a theory that firms cannot be productive. And if you know agency theory, and I'll come back to this, particularly Michael Jensen, I have a nice slide or two on him. Agency theory starts really from the assumption that anytime a manager invests in a company, it's a waste of resources. They're just trying to build their empires or whatever they're trying to do, and you have to disgorge the free cash flow. And that's what maximizing shareholder is about in terms of corporate governance, get the market to work. Okay, now who started all this? It's generally recognized that Milton Friedman, the Chicago economist, launched the shareholder value movement with a 1970 article published in the New York Times Magazine. In September 1970, it was the month and year that I entered the PhD program in the Harvard economics department. If I had known then what I know now, I could have written my thesis right away, and it would have been what I'm talking about today. But it took me quite a long time to figure all this stuff out. But at least I came in there thinking critically about the economy right from the start, given some prior experience in education, et cetera. And so, you know, these issues were on my radar screen. Okay, and now Friedman himself, he was the counterpart of Samuelson. He was the I call him in one slide, the neoconservative mythologizer of the market economy, Samuelson, the neoliberal mythologizer of the market economy. A colleague of mine at Harvard, Stephen Margolin, used to talk about neoclassical economics as running the intellectual gamut from A to B. And I think that well describes it. There's not really that much debate between them. I won't get into that. Okay, now in terms of this argument that was made in this article, I'm going to go through this carefully, and also the context in which it was made, because the context is usually not understood. Okay, so the article itself, it appeared in the magazine in 1970, and it says, in a free enterprise private property system, a corporate executive is an employee of the owners of the business. He has direct responsibility to his employers. That responsibility is to conduct the business in accordance with their desires, which generally will be to make as much money as possible while conforming to the basic rules of the society, both those embodied in law and embodied in ethical custom. Sounds good, okay, until we start tearing it apart. Now, he concludes that article by quoting himself from his 1962 book, Capitalism, Friedman, and I put in the previous slide, you know, how are we defining capitalism, how are we defining freedom? But in any case, he said there is one and only one social responsibility of business to use its resources and engage in activities designed to increase its profits so long as it stays within the rules of the game, which is to say engages in open and free competition without deception or fraud. Okay, now I had for years, for me, it was an infamous argument for the agency theorists. It was a famous argument. It was an inspiration. But for me, it appeared so everywhere. I did not actually know the context. It was actually a fellow who was at INSEAD, Michael Lazonick, who sent me the PDF from the New York Times. And I always use PDFs from the historical New York Times, but I'd never bothered looking at the context till a number of years ago. And then that context was very enlightening, because this is the way it appeared in the New York Times. And I'll show you some other pictures as well. Okay, it says a Friedman doctrine. So first of all, it's putting Friedman forth there. And it says the social responsibility of the business increases profits. I put those little blue boxes there. James Roach, the GM chairman at the May annual general meeting, shareholders talking to people we'll see on the next slide who were part of campaign GM, and we'll talk about what they were doing. And they had buttons on their wearing buttons called Taming GM, and this box at the lower left corner, I'm going to reproduce that so you can read it. It's very important. But it was whomever at the New York Times solicited the article from Friedman in September of 1970. He most likely gives the reasons. He lays out the context in which this happened. Now, here are some of the campaign GM organizers wearing their Tame GM buttons. The one on the lower right is a guy named Reverend Channing Phillips, and we'll see he was one of the people that campaign GM wanted to put on the board of General Motors. Okay, now campaign GM was inspired in part by Ralph Nader, 1965 expose of the dangers of GM's Chevrolet Corvair. How you say, I get interviewed fairly often by Ralph Nader on his hour, including last June. He's become a big critic of stock buybacks, and we see eye to eye on a lot of things. But he started really the consumer movement in the United States and maybe even beyond with this critique of products, unsafe products, and was particularly focused on GM products, and particularly a smaller car, the Corvair. Now, campaign GM wanted 3 people to be appointed as public interest directors to the board of directors, which otherwise would just be representing shareholders, to address the issues of diversity, safety, and pollution. So in that photo I showed you before, James Roach is addressing the members of campaign GM. And here's what it said in that box that you couldn't read there. It said that the campaign GM demanded that GM named 3 new directors who represent the public interest and set up a committee to study the company's performance in such areas of public concern as safety and pollution. The stockholders, that was in the meeting was in May, Friedman's article is September. The stockholders defeated the proposals overwhelmingly, but management, apparently in response to the second demand, that is that they look at concern with safety and pollution, appointed named 5 directors to a public policy committee. The author, Milton Friedman, calls such drives for social responsibility in business, in this case, I guess even having a group of people look into this as public policy is an issue, pure and unadulterated socialism, adding businessmen who talk this way, and this is Friedman's words, are quoted by the editor, are unwitting puppets of the intellectual forces that have been undermining the basis of free society. So now that we know the context, let's look at what Friedman has to say. Well, first of all, before we get into that, I just want to say a little bit about the demand for an African-American director. As you probably know, the Civil Rights Act passed in 1964. The Equal Employment Opportunity Commission was created in 1965 in the United States. And in 1968, quite a number of African-Americans, larger numbers, got elected to Congress. And the woman shown there is Shirley Chisholm, who was elected and as actually the first woman in the United States and first Black person in the United States ever to be a contender for the Democratic nomination for president, which she, I think, was in, would have been 76, I believe, or 72 or 76. And 9 Black members in the House of Representatives were part of Campaign GM. And actually in 1971, they formed the Black Congressional Caucus, and it may have been influenced by them getting together over this issue. Now, it wasn't just that they wanted someone on this board of directors. The auto industry was very important to African Americans by this time in the late 1960s and coming into the 1970s. And this is a subject of a book that will be coming out from Cambridge University Press. We have to get the final version in with my co-authors, Philip Moss and Joshua White, who you see there, by the end of August. But it's basically written, and it'll come out within hopefully a year from then. But basically, what we show in that book is that in the 1960s and 1970s, for various reasons, African Americans moved up the hierarchy in companies. And in the auto industry was very important, moving from unskilled jobs to semi-skilled jobs, where wages were pretty middle class by then, or lower middle class, and very secure, supported by unions. And they became a disproportionate, they were about 12% of the population. They started being 25–30% of union members. And the auto industry was a central part. In that picture, it's hard to see it, maybe. Actually, that it seems that was in the GM annual report from 1979. And it wasn't exactly clear why they were putting it there, but what you can read on there is that between 1965 and 1979, actually employees got more, suppliers got more, and shareholders got less. And I think they were actually bragging about that at that point. That's before shareholder value kicked in, because it wasn't just at the blue collar level that you had basically lifetime employment. First hired, last fired, seniority, that was the basis of US unionism, but it was also for white collar workers, a career with one company, defined benefit pensions, health coverage, and that was true at other companies, large companies, including General Motors, and that wasn't questioned at that time, but it would be questioned quite a lot in the 1980s with the coming of shareholder value. So Campaign GM, therefore, one of the things they wanted was a Black director on the board. Now, one of the things that appears in the article, and this is from excerpt from the article, and there's a picture which basically says that there's a former member of the hardcore unemployed is been hired and is being given new gloves by some existing employees. And in the article, it's underlined there, Friedman says that, managers should not be engaging in what is basically, he doesn't use the term affirmative action, at the expense of corporate profits, But he does that and he hires hardcore unemployed instead of better qualified available workers to contribute to the social objective of reducing poverty. That is something you should not do. Okay, now it's actually there's a certain amount of racism there. It is racist. I mean, they could have come out and say they're hiring black workers instead of who are hardcore unemployed rather than white workers. But that's what the New York Times was publishing at that time. They've done worse since then, but that's what they were doing. Now, in terms of pollution, he doesn't actually talk about safety, so he doesn't actually correctly address Nader's central issue, but the anti-pollution environmental movement was gaining steam as well. He said that they shouldn't be making expenditures and reducing pollution beyond the amount that is in the best interest of the corporation that is required by law in order to contribute to the social objective of improving the environment. And they sort of repeat that under this picture of a demonstration in New York against pollution. Okay, now, of course, what's in the best interest of the corporation? We'll come back to that in a minute. And what is required by law? Well, what is required by law is going to be in part determined by people protesting for changes in the law. So unless Friedman can tell us that there is some law set in stone that that corporations are supposed to follow, no, they're products of society and they should be responding to society. But there's more to it than that, because here's really where the theory of innovative enterprise comes in. It wasn't just that Milton Friedman was arguing against what we could now call the SG, social responsibility or whatever. He was telling the board of General Motors shareholders, society, that GM should not invest in innovation. Well, how do we know that? Because we know what the future of the automobile industry was. The companies that won out were producing safer cars, more fuel-efficient cars. And actually, the African-American labor force was a big asset to these companies until they started, in the name of shareholder value, laying those people off in the 1980s. And they were last hired, first fired. And as we, Phil and I describe in our book, that was the prelude to white blue-collar workers being laid off, and ultimately, to kind of put it in a nutshell, voting for Donald Trump, some decades later. Okay, so that's what Friedman is really arguing. Pure and unadulterated socialism, for him, was the future of innovative future of the global automobile industry. So I'm going to spend a few minutes looking at General Motors in some more detail, right up to the present, including an article that Matt Hopkins and I just wrote a couple months ago, which if these lectures hadn't had to be rescheduled, we actually wouldn't have had included in the lecture because it was done in December. So you're getting at least the benefit of that. And here's a picture. This I didn't bother updating it past 2019, but I put some of the numbers in. GM's loss of share in the U.S. motor vehicle market has been declining since 2019. And even though until 2019, and even further now, even though it was getting more and more cars being sold in China. And in fact, its global market share which was 15% in 2001, is now down to about half that. China, which was actually where their market share of cars in as recently as 2018 and 2000. I have 19 even was over 40%, is now down to about 10%. Okay, so GM, they should have hired those directors. So that speaks for itself. I mean, what I have up in the right-hand corner, give this genius a Nobel Prize. That's what they did for arguing against the future of the automobile industry, the future of society, and the role of corporations, not in being social responsible per se, but responding to the needs of society, higher quality products, okay, and then delivering them at lower unit costs. For that, you need a theory of innovative enterprise, which Friedman didn't have. Now, the thing about Friedman, before I got into this critique, I would just say, well, you read Friedman, he knows nothing about the corporation. He totally is in line with Samuelson in terms of the unproductive firm that I talked about. So that's why, actually, as I said yesterday, I'm really exposing Friedman. He knows nothing about corporations. There's no reason to listen to this guy. No reason at all to listen to this guy. He played around with some macroeconomic statistics and some ideology and something I'll come to later, a really stupid methodology that economists adopted called positive economics. Okay. Maybe compared to him, Samuelson had some saving graces. Okay. Okay, now let's look at GM a little closer, how they allocated their resources up until they went bankrupt in 2009, were bailed out by the US government. They did it by giving away all their money to shareholders. 1986, 2002, it's 95% of their profits are going to dividends and stock buybacks. Okay, 1997 to 2000, a critical point in terms of growth and competition. They did almost 13 billion in buybacks, and Matt Hopkins and I and Oner Tulin have and Erdem Kasakian, who work with me, have related this to executive pay and the way in which executives are incentivized to do stock buybacks to boost their pay. Long ago, I wrote this thing that if GM had banked the $20+ billion in buybacks distributed to shareholders over these 17 years with a 2.5% annual tax returns, it would have had hypothetically $34 billion of cash in 2009, which could have kept it afloat. The government would have had to bail it out at that time. Instead, after reducing entry rate wages to $14 an hour from $28 an hour in 2007, GM went bankrupt in 2009, turned to taxpayers and workers to bail it out. So this is the legacy of Friedman's argument going back to 1970. And then who paid for the bailout? Okay, in the bailout, financial firms, shareholders, hedge funds, Wall Street, nowhere to be found. It was US taxpayers who put up about $50 billion in rescue funding, Canadian taxpayers about $11 billion. They emerged from bankruptcy, GM, in 40 days. Went on the stock market, back on the stock market, the new GM in 2010, one of the largest IPOs in history. The automobile workers took 11 billion in pay cuts, 1,000 layoffs, wage freeze, $14 per hour for non-core new hires, reduced funding for unemployed workers, no strike agreement to 2015. The union took GM shares to refund its pension and health benefits that GM had originally funded itself. The workers bore the brunt of the taxpayers. Once they went on the market in 2010, all these people in Wall Street and in Washington who basically, whether it's liberals or conservatives, but we're talking about government motors. What is GM? Why are GM shares being held by the government? They should sell off the shares. So they sold them off too early. $11 billion loss to U.S. taxpayers. Okay, now in February 2015, I mean, the story goes on. GM decided to pay out of the blue, apparently, 48,400 GM workers, a total of $116 million in an extra bonus for their profitability that they had achieved, as GM was agreeing to do a $5 billion stock buyback. Now, the context in which they did that buyback, which is an subject article that Matt Hopkins and I did back in 2015 in Harvard Business Review, was a guy named Harry J. Wilson, who led a group of hedge funds demanding the GM do an $8 billion buyback and give Wilson a seat on the board. He wants a seat on the board so he can actually get them to do even more buybacks in the future. GM agreed to a $5 billion buyback and no seat on the board. And actually, at that time, there was the president of the UAW was still on the board of General Motors as a result of the bankruptcy, and he made this feeble argument it was too much too early, and he should have said no way. Okay, Who was this guy, Harry J. Wilson? He was a hedge fund manager, had retired at the age of 2007 with his whatever, hundreds of billions or tens of billions at the age of 36. He was a Republican who volunteered to be on Obama's task force for bailing out GM and Chrysler. He was the one that insisted that the bailout be in stock and the government hold the stock. It should have been done in bonds. It should have been done so the government was a senior creditor and GM could not do anything until it paid off that debt. And there was a labor guy named Ron Bloom who was on the task force who unsuccessfully argued for that position. But this guy, Wilson, I mean, it's a scandal. He got the job, structured the bailout in this way, and then came back saying that's our money. They had nothing to do, not one a bit of funding for that bailout or to get GM to 2015 came from shareholders. They just bought the shares that the government sold once the company was public. Okay, more recently, and this is the article that Matt and I did a couple months ago, after the UAW strike, which you might know of, the United Auto Workers, big strike in September, October, they wanted to make shareholders happy, so they did a $10 billion buyback. It was actually what's called an accelerated share repurchase, which means that they did it all at once. I won't go into that, but it's really just a big boost. It's accelerated boost of their stock price. And that was about part of about $24.4 billion that they'd done since 2015, since Harry J. Wilson showed up with Mary Barra, who is actually her father was a tool and die maker at General Motors for almost 40 years. She went to General Motors University, became an engineer, and came up through the company. She's a production person, but she has to kowtow to the hedge funds, and there was another raid on them in 2017. The only reason they are doing all these buybacks, it's not their pay in this case. It's to keep their jobs. If they don't do it, the hedge funds will, and if I can't go into I'll talk a tiny bit about this argument, but when I talk about the book Predatory Value Extraction, which I did with Jiang Sub Shin. Okay, so here I put some faces on this of economists. One's familiar with you and the other one is maybe not, but it's Michael Jensen. Retain and reinvest organizations are important to the economy, and there you'll have much more stable and equitable growth going on in the post-war 2 decades. And then Michael Jensen comes along with maximizing shareholder value, discourage your free cash flow, and you have this place where the predators pay. Okay, now Edith in her 3rd edition, as a result of actually a meeting with me and Mike Best in the early 90s, Mike we were talking at dinner yesterday how well he got to know Edith during this period, and though I had known her work before then, introduced me to her here in Cambridge. And she actually was at a conference at Harvard Business School where she stayed at my house in 1992, and I gave this paper called Controlling the Market for Corporate Control, the historical significance of managerial capitalism, which I'd actually presented at a seminar at Harvard Business School in 1992, and I won't go into it. It got me a ban from Harvard Business School. No one invited me back there, even though I lived 20 minutes away, 10 minutes by car, for 17 years. There's Michael Jensen. At one point, writing, I usually don't write about people this way, but I called him the chief academic cheerleader for maximizing shareholder value, and I found this little jumping jack on Microsoft animations, and so I stuck his head on top of it. But what's important is what he says. He says free cash flow is cash flow in excess of that required to fund all projects that have positive net present values when discounted at the relevant cost of capital. You can see all the assumptions that are being made there. Conflicts of interest between shareholders and managers over payout policies are especially severe when the organization generates substantial free cash flow. That is when it has a lot of profits. Who gets access to those profits? Okay. The problem is how to motivate managers to disgorge the cash rather than investing at below cost or wasting on organizational inefficiency. You can see the unproductive firm there, the notion that firms are inherently unproductive coming in there. Okay, now if you break that down, discourage, that means somehow it shouldn't be there. Well, it's there because, or maybe there, because there are ways of getting profits that are purely exploitative, price gouging of consumers, exploiting workers. That goes along with maximizing shareholder value. But when it actually are the profits of innovative enterprise, then it should be there. It was created there. What is being disgorged? Whose cash? So this term free cash flow appears in every annual report of companies. It's just a term that everybody takes for granted. But if you ask the question of what it is, you lay off 5,000 workers, you have free cash flow. You suppress wages, you have free cash flow. You avoid corporate taxes, more free cash flow. Price gouge consumers, etc., or fail to reinvest in innovation, free cash flow. And so integral to this is actually incentivizing. This is something that Jensen argued for, incentivizing managers to align with shareholders by having lots of stock-based pay, which they gladly did. Okay, now the ideology that behind this that seeks to legitimize shareholder value is the assumption that shareholders are the only actors who invest in the corporation without a guaranteed return. So they take risks. They're the only ones who take risks. And therefore, if there's profits, it belongs to them. If there's losses, they have to bear the burden of it. It's a crock. Okay, when I pay my taxes, some of those taxes go into infrastructure, go into creating the labor force. The corporate taxes are generally, you can see them at a reasonable level, paying back taxpayers for the use of those resources. But companies say, no, we have to have lower taxes or else we're not going to be able to compete. What do they do with the lower taxes? More stock buybacks and dividends. Okay. So I'm making a risky investment in the future when I pay my taxes through government agencies. Okay. Workers are doing the same thing when they go to work hard, expect to be employed, not just tomorrow, next month, next year, and they get laid off. So they're taking risk and not getting rewarded. The irony is that the ones who take the least risk are public shareholders because they can sell their shares at any time. And in fact, and I'll give you some examples of this, some egregious examples, shareholders who buy even billions of dollars worth of shares on the market do not contribute 1 cent to the company, but can extract even multiples of the amount that they bought on the market when they sell their shares, particularly if a company is pumping up their stock price with buybacks, and they love it, and that's what they push for. So that's what disgorging the free cash flow means. Okay, now how does maximizing shareholder undermine innovation? It's destructive of innovative enterprise. So I laid out 3 social conditions of innovative enterprise yesterday. Strategic control. It permits the separation of the interests of the top manager from the rest of the organization for their personal gain. It basically hollows out organizational learning. There might be workers there, but they're not investing in learning. They're often laying off people who are critical to the learning process. And so it undermines organizational integration. And then it directly takes money away that could be invested in the company and sustain innovation by predatory value extraction to take more than they make. Now, when I make this argument, it's not just about the amount of money. It's actually more fundamentally about what it does to strategic control and organizational integration. So you have to look at the whole innovative enterprise to see the problem. So there's many companies that can do huge billions of dollars. Apple is one of them. I'll give you the example of buybacks and still have plenty of money to reinvest. They're just so profitable. But so that isn't the sole problem, although it can become a problem. This is enabled by the Securities and Exchange Commission, which basically, when it was captured by Chicago economists after Reagan got elected, turned from being a regulator to a promoter of the stock market or financial markets, and passed under the radar a rule called 10b-18, which allows companies to do massive amounts of stock buybacks on any given day without being charged with manipulation of the market. You'll see the subtitle here. Agency assures it won't file charges of manipulation if certain rules are met. It didn't say to this day it's not manipulation if you do, let's say, $100 million of stock buybacks per day. Or in the case of Apple, they're under the rule they can do about $4 billion a day, day after day after day. It's not saying that isn't manipulation. They gave them a safe harbor to say we won't charge you with manipulation. It was basically 25% of their average daily trading volume over the previous 4 weeks. Now, this really became a dominant ideology actually after that rule was passed. And so you had this tool to disgorge the free cash flow provided to you by the US government, this agency that was supposed to regulate the stock market. And this from an article that documented hits in the Wall Street Journal. And I think a lot of it had to do with the hiring of Jensen at Harvard Business School in 1985. I was at Harvard Business School from 1984 to 1986 as a research fellow. I can tell you that nobody at Harvard Business School was arguing about maximizing shareholder value in 1984. 1986, everybody was, because Jensen came there. They brought him there because he was going to bring lots of money, or they had more money than they knew what to do with anyway, Harvard Business School. The students, MBAs, were going into Wall Street rather than to industry. The executive programs were all teaching about maximizing shareholder value, and this then got out in the press, and everybody started talking about it and took it. So it's actually a relatively new phenomenon, and you can identify ways in which this happened. There's another article which documents the same thing, really, in the Financial Times, New York Times, Wall Street Journal. This is something we purposely just updated it to 2019, back to 1981, because every year we updated, we lose some companies, because these are companies that were on the stock market over the whole period. And you can see that in 1981-83, around the time when this Rule 10b-18 was adopted, buybacks were minimal and dividends were about 50%. The last 3 years, 2017, 2019, the same companies. This would include Apple, because it went public in 1980, but not Microsoft, which was a big repurchaser, went public in 1986. Buybacks are 62% and dividends are about the same, 50%. Here I break it down by 5-year periods, and if you look at the bottom line of that table, you just see the proportion of net income that's going to buybacks and dividends becoming greater and greater. Now, particularly in the book that came out recently in Investing in Innovation, but I've done it in many other places, I talk about 3 kind of corporate governance regimes: retain and reinvest, retain profits and invest in productive capabilities, first and foremost of the labor force. Dominate and distribute. A company like Microsoft or Apple dominates its market and makes profits, but distributes all those profits, and not sometimes even more, taking on debt, sometimes firing workers, selling assets to shareholders in the form of dividends and buybacks, and often getting to the downsides and distribute, where they're no longer really dominant, but they are just downsizing their labor force for the sake of distribution to shareholders. And I won't go through it. I basically, there's a picture of this here. I just skip ahead of the 20 largest repurchasers, which I go through in that book, where I go through which ones are in which phase. Okay, now just to review very quickly how some business corporations grow to be large. It's more what I talked about yesterday. Basically, they invest in collective and cumulative learning. They generate a higher quality product that gets them a larger share of the market. They can spread out the fixed cost of that investment in people, which is a fixed cost, because you don't realize it right away. You have to realize in the future. And can hopefully get economies of scale by maintaining the quality as they're spreading those fixed costs over more plant equipment and people over more and more output. And therefore be able to outcompete other companies with a higher quality, lower cost product. This can occur through reinvestment to profit in the firm to leverage organizational learning of its labor force. Can also occur through internal development or mergers and acquisitions, external collaborations. You can't say, if you just look at a company doing a merger and acquisition, or an acquisition, let's say, that it's good or bad. It may actually be building its innovative capabilities, but it may be, as in the pharmaceutical industry, I'll come to the cases of Merck and Pfizer. For decades, they acquire other companies with patent life left, milk the patents wherever they can in terms of getting distributions to shareholders, and so that when they did those mergers, they got hold of assets. They took strategic control of assets that they were tearing down, not building up. But you have to look at that. Okay, now, how does a corporation go from innovation to financialization? Basically, most of the thing that I've focused on, and I'll get to in a minute, the difference between buybacks and dividends, most of the companies that do the large-scale buybacks, and this is much more American phenomenon than a European phenomenon, but not that does exist in Europe, are ones that have been highly profitable. And they often do it in addition to dividends, not instead of dividends. Okay. And but they reward shareholders who typically have never invested in the productive capabilities of the firm. The dividends, difference between dividends and buybacks, which I kind of have on another slide, but I'll just mention it here, is that dividends go to all shareholders of a class. Buybacks go to share sellers. The people who realize the gains are those who buy and sell the shares at the right time. Anybody who's a hedge fund activist in the United States worth his or her salt knows when companies are doing buybacks, as do the executives inside the company. And so they're gaining buyback with non-public knowledge under rules that have been in place from the Securities and Exchange Commission since 1982. Now, what they do is then they start, once they do all these large-scale distributions, strategic control changes, organizational integration changes, they run the company to get more profits, to do more distributions. They start looking to downsize the labor force, avoid taxes, price gouges has become a big issue with inflation discussions, useful discussions of inflation in the United States recently. And basically, there's a lot of collateral behavior that is not desirable behavior of companies that to get their profits up for the sake, not just to get their profits up for the sake of doing these distributions to shareholders. Okay, and then they basically are using their market power in that way. So I see the large corporation not so much a problem because it's large. The large corporations problem because it actually, well, they delivered the goods over a period of time. But now some people have come in there with Milton Friedman's, the ideology that Milton Friedman launched, and saying that money is ours, and that they take away from the people who really are bearing the risk and really doing the work of creating value. This is an article with Aaron Sedkinch and Matt Hopkins we published just before the pandemic started on buybacks, which companies do them when prices are high, because they're all competing to get their prices of the buybacks higher. And in that article, we also document the extent they were doing it when interest rates were low with debt. They were taking on debt to actually give away the money of the company. Okay, in investing in innovation, I argue why stock buybacks in particular undermine the investment innovation. If you have CEO and CFO whose main job is to manipulate the stock price, they're not going to be focused on how to invest in a new round of innovation. The company that does buybacks undermines the learning of its labor force because it's not paying attention to what's going on in terms of maintaining the labor force and retraining the labor force, et cetera, creating incentives to the labor force. At some point, the company will cease to reap sales and profits from existing products and find itself in financial distress, and I can go into many companies for which this happened. Okay, this is the book that Jang-Suk Shin and I, that cover at least published in 2020, and basically, if you see where it says 4, 5, and 6 there, well, 3, first of all, we argue that after talking about the theory of innovative enterprise, the stock market is a value extracting institution in the United States, and the value extractors are the insiders, the executives, the enablers, these are the fund managers, pension funds, mutual funds, and the outsiders who become very powerful become hedge fund managers who with 1% of the shares can actually take over a company. I won't go into how they do that, but you can both read that book, and actually Jang-Suk has written stuff that he's done on that up as a separate paper that is probably going to be published separately updated. Here is just very quickly some examples of what we've done where we've shown the damage that can be done. This is an article that Erdem Sedkinch and I wrote on Boeing in 2019 after the crashes in 2008, 2019 of the 737 MAX. So you probably know that Boeing's had more trouble recently, and people were calling me up and asking for updates on this article. In that article, we have this graph. Those blue lines are their stock buybacks. I mean, basically from 2013 to the week before the second crash, they were doing massive stock buybacks, billions of dollars. And if actually that was against the profits that were coming from the orders that were going 9 years out, much of which then evaporated. And I give some data on, it's hard to see, on executive pay there, but basically the executives running the company, they knew they were unsafe planes. And if they didn't know, they should be in jail now. But they knew that, and they should be in jail for that too. And neither, of course, they're not. But they wanted to keep the stock price up. That was why they were running the company. There was no secret, and it was showed up in the way they were allocating resources. We keep putting out new data on this. The pharma companies, called the latest article in Competition and Change, we call it Sick with Shareholder Value, owner Tool and I, and there at the top right, you see 14 S&P 500 pharma companies among the 500 in the S&P 500 index. We look at them over 10 years, so some of them are not in for the whole 10 years. So there's 474 companies. They did, those pharma companies did distribution to shareholders, 747 $1 billion, research and development, $660 billion. Their lobby and the companies argue they need high drug prices to fund innovation. No, this is what they need high drug prices for. It's a pretty open and shut case. Here, just some data on Merck and Pfizer having been doing buybacks for decades and moving from innovation and financialization more recently over the last decade, the tens of millions of dollars that their executives have made year after year by running financialized companies. This is a book that Antonio Andioni, of course, you know, and owner Tool and I published, I guess it was a year ago, it came out. And it shows that in what we found, it wasn't what we necessarily expected, was that AstraZeneca and GlaxoSmithKline, the two British-based big pharma companies, actually went from financialization to innovation. AstraZeneca more markedly in 2013 when they hired Pascal Soriot, stop buybacks. And we basically think they did it in order to remain British companies and we're not getting taken over by other companies. And they realized that they can no longer just make profits, the blockbuster model, getting blockbuster drugs through the mergers, and the one they had done before in 1999, 2000, the patents were expiring, they had to invest in the pipeline. All the companies now, because it's so consolidated, the industry have recognized that, including Pfizer and Merck. In Pfizer in 2019 stopped doing buybacks even before it knew that it would get lucky with the pandemic because it needed to invest in the pipeline. Another study we've done, this with Murray Carpenter, on Cisco, which should be Huawei. It should be the company that's a leader in 5G and Internet of Things. It's big, but it's an enterprise networking company. It hasn't really been innovative in over 20 years. Lost out in Zoom was part of Cisco. The people left Cisco to start Zoom and et cetera. And they spent all their money and more, profits and more since 2002, buying back their stock and to prop up their stock price. We recently intervened when the Chips versus Science Act came out. The US government was saying, okay, which has now been passed, $52 billion for the semiconductor industry. And we said, that's fine, but why are 9 companies that are lobbying for this? Why do you know that they did 17 times that amount, $882 billion over the last decade? It actually had an impact because at least, and we'll see how they implemented, the Department of Commerce, which is overseeing giving out this money, however, hiring people from Goldman Sachs to do it, has said that companies that get the money can't do stock buybacks while they have those subsidies. They also have to set up daycare centers, which is interesting. Intel is a company that's obsessed with maximizing shareholder value. I give some numbers here. What's interesting about Intel, or one thing is interesting, is they realized that if they were going to compete against TSMC and Samsung, they had to invest in the company, and particularly in EUV, being able to use EUV machines from ASML, being able to do the 3 nanometer production, where they're not close to. So they brought back a production guy. Gelsinger had been really in charge when he was in his late 20s of the microprocessor from Intel in the 1980s. They brought him back as a CEO, and I don't think he has anything against buybacks ideologically. I doubt whether he's ever read anything of mine. He may have read an article of mine, Harvard Business Review, but he came in and he said, no more buybacks. And the reason he said it, as you can see in this quote, I won't read it, but he said basically it was because we got to get people working together. It's organizational integration. It's the learning process we have to get. Now, they are in a bit of trouble now, Intel, because they're having to make massive investments and they could use all that money they gave away. Apple is the biggest looter of corporate treasury in history, $651 billion in just over 11 years, in buybacks, $148 billion in dividends. That's a total of 111% of its net income. They call it the capital return program. It's totally ideological. Who you're returning capital to. The only time they ever got money from the public stock market was in 1980, $97 million. And all those people probably have sold their shares. If anybody is still holding the shares, they probably don't want them to be giving away the money who people just bought the shares last year or a year, 2 years ago. Okay, Carl Icahn, a well-known corporate raider, went to the market, bought $3.6 billion of shares, had a high-profile campaign to get Apple to do buybacks. They did record-breaking buybacks in 2015, 14-15. He then sold the shares to a $2 billion gain. That's how the rich get richer. At the same time as he was selling the shares, Warren Buffett, the so-called patient capitalist, who actually did build a very unique company with 390,000 employees at Berkshire Hathaway, but has huge amount of money from stable employment that he doesn't know what to do with in his 90s. He bought Apple stock, about 10 times what Icahn bought. And he has basically had 5% of the company. He then was quoted in an interview of saying that he loved buybacks at Apple, even though they didn't do them at the time at Berkshire Hathaway, because he could get 6 or 7% of Apple without laying out a dime. You know, what is it? First of all, it's totally morally corrupt. But what kind of argument is that? Yeah, we're going to steal that money. And in fact, Buffett, he still holds most of the shares that he bought, but he's sitting on $140 billion of unrealized gains. You know, remember that New York Times article, that red line there? That's where it's coming from. And you know, if we had enough resources, we could document this extensively. Apple could have invested in a fab. If they had invested in a fab, Samsung back in 2010, and actually someone advised them to do this, Samsung and TSMC would not be world leaders in EUV production. At least they wouldn't be world leaders because they got the Apple microprocessor contract, which is critical. It's critical to the EUV technologies, the 7 nanometer, 5 nanometer, now 3 nanometer chips. Okay, few more things here. Edith Penrose article, as Christine mentioned, growth of the firm appeared in 1960. It's not clear to me why it wasn't in the book. They say because of size. I think Edith probably didn't want economists to say, oh, it was all based on one case study or theory of the growth of the firm. So she hasn't even mentioned, even though she did the field work in 1955, the growth of the firm. It's an excellent article on what Chandler was talking about, even when they weren't really even, as far as I know, knew about what Edith was doing on the multidivisional structure. Excellent article. There is a really good book that was written and commissioned by Hercules Powder, the company called Hercules then, came out in 1990 for the 75th anniversary of Hercules, and Hercules remained innovative for a long time. Matt Hopkins, who just got his PhD thesis to his defense here, just about to graduate, has a chapter, which you can probably see soon, on what happened to Hercules from 1988 to 2007, totally financialized. Okay, I'm getting just 2 more minutes. Okay, economists with like Friedman and Samuelson and their acolytes, and which is basically most of the economics profession, can't understand any of this stuff because they bought into this notion that Friedman put forward in 1953 of positive economics. Doesn't matter what your assumptions are about as long as your predictions are accurate. But what happens when the predictions are wrong? Do economists reject the model? So have they said, well, Samuelson predicted the most unproductive firm is the foundation of the most efficient economy and then rejected the neoclassical theory of the firm? No, I don't think so. And they actually haven't even asked the question about whether the prediction was wrong. Friedman positioned that GM would do just fine by maximizing shareholder value. I showed that that's not the case. You could give, those are just the arguments, that I made here, but it's the argument after the argument. But even if they do recognize that the predictions are wrong, what do they do about it? How do they find? They don't have a methodology for looking at facts and logic, history and theory. And this is where basically I'll end, because Edith Penrose did. These are my words at the top. Theory serves as both a distillation of what we have learned from the study of history and a guide to researching what we need to know as the present of history unfold. And Edith Penrose, an article that was presented at an international Congress in 1986, published in 1989, articulates it by saying that theory is by definition of a simplification of a reality, and she ends up by saying that economists who say that universal truth without reference or put forth universal truth without reference to time and space are unlikely to characterize, those universal truths are unlikely to characterize economic affairs. And she's basically arguing a methodology that, whether she understood it or not, or articulated it or not, was an integration of theory and history. So 65 years after the publication of her book, The Theory of Both Affirm, she might have added that a failure to integrate history and theory has led to 3 generations of economists to accept the neoclassical fallacy: the most unproductive firm is the foundation of the most efficient economy, and shareholder value maximization had come out of it as universal truth. So the next generation, some sitting here, need to engage in our own collective and cumulative learning and about how the economy actually works, that we're trying to analyze, and how we can get it to actually perform the way we want it to perform. And just as a small way of entering that process, well, everybody should read Edith Penrose Classic for a start. So now I've obliterated Friedman, and that's all for now, folks. Thank you.
Great. Well, thank you very much, Bill, for that tour de force. I mean, to see all the work you've done represented there in yesterday's lecture and today's lecture, it really lays bare, what's happening on financialization. And I think what's even more interesting to me is how that's linked with innovation. And we've got some time now for questions before we go off for drinks. So who would like to start? Yeah, please.
Thanks. Thanks again, the very great second lecture as well. There was an article in the FT yesterday or the day before, I think, about the Argentinian President Milei, and he was quoted something along the line saying, what we're doing can't go wrong or it can't be bad because it's what the models tell us to do. And I know your work is mostly in the US, but I was wondering if you can see sort of a pattern in the degree between countries to which they sort of adopt the sort of fallacy of neoclassical economics or positive economics, and the effect that has on innovation between those countries.
Okay, is this working? Yeah. Okay, well, that's a good question. And so on one level, more what I talked about yesterday, you can see it's in every textbook worldwide. So if someone can send me a textbook, even a left-wing textbook, even a progressive textbook in which they don't have the upward sloping supply curve, and take that as fundamental, please send it to me, or at least let me know about it. I'll see if I can get it at a low price on Amazon. In terms of what I talked about today, that this is of great interest to me, and actually the book that Antonio Andreoni and Owen Trulam and I wrote on UK Pharma, we're pursuing this further because it is a question of what's the difference even between the UK and the US in terms of maximizing shareholder value. So one of the things I think we found looking at that was there was a reaction which led to codes of corporate governance in the UK in the 1990s against the extreme version. So you have shareholder primacy in the UK, there's no doubt, but the extreme version of that coming from the United States. And I think that it actually helped AstraZeneca and GSK fend off the predators, both of which are rated. And actually, one of those predators was Paul Singer, Elliott Management, who bought a stake in GSK in 2017, trying to get rid of Elmer Walmsley. Failed. He probably would have been successful in the United States for reasons having to do with the proxy voting system. But he also took his vulture capitalism worldwide, it's very well known, by buying Argentinians as distressed debt in 2001. And anybody thinks that this was a short-term thing of making some quick money, it took them about 14 years to get laws changed and the support from the Obama administration and law in the United States, and a change in regime in Argentina to pull $2.6 billion out of that country that the people are paying for still. So there's your model there. But I think that is a really interesting question about the which I am interested in, about the extent to which this American model of shareholder value has migrated around the world and been constrained. A big perpetrator of this, and I've had interaction with people there over the years, is the OECD, which in 1999 adopted shareholder value as the prime goal of corporations on a global scale. And I've been brought into OECD at times to talk against that by people when they've been having their corporate governance meeting. And typically the people who are coming from around the world to those meetings are shareholder value people, even though those countries they're coming from might have much stronger stakeholder constituencies.
Thank you very much. In the spirit of integrating theory and history, I'd like to ask you, it's perhaps a more academic question, but you emphasize how the firm creates value cooperatively by involving a lot of different actors, including the employees and so on. And I'm not arguing against that, but has that always been true since the Industrial Revolution, or is that a kind of fairly modern feature? Maybe it's connected with the rise of labor organization or something, because my reading of like early capitalism and into the 19th century, perhaps even beyond, the innovation actually came from the top, and the employees were treated as fodder, really, and disposable.
Yeah, well, so I had mentioned this yesterday, but you can go read an article of mine that I published in Cambridge Journal of Economics, and it appears in some book, but my book, Competitive Advantage on the Shop Floor, about mule spinning in 19th century England, where the spindles went from 144 per machine, and there'd be a pair of them, to 10 times that amount over the course of the century. And it required the cooperation of the mule spinners to do this. And they adopted wage lists, which the employers abided by, to share out the gains. And it was a highly productive system as long as that technology dominated. And as long as you didn't have the rise of new competitors. The United States arose with the new technologies, ring spinning, automatic looms, but their wages were too high to compete without tariffs. But then Japan came along and innovated. They bought all their spinning equipment from the UK, but in automatic looms, a company that led to the Toyota Motor Company. And so, and in all those cases, you'll find that these leading innovators are sharing the gains with their employees. Now, it doesn't mean that if they can get certain employees who don't matter as much, who are easily replaced, they won't exploit some of them in a kind of Marxian way. At the same time, they're creating what Engels, again, as I said yesterday, called the aristocracy of labor. Yeah, I had on this stuff just to mention it because one of the great economic historians in Britain is Eric Hobsbawm, and actually that paper I first gave just right around the corner at his seminar in 1979, and he wrote about it. Anyway, I had a lot of good interaction with him about these very issues, and he was the one who started talking about the aristocracy of labor in Britain in the coming out of the late 19th century.
The paper was in 1979?
Yeah, it was in the Cambridge Journal of Economics. I can send you a copy.
There's more questions? Yes, please.
Don't think I'm loud enough. Thank you very much. Very insightful and very detailed, in-depth analysis, which I really appreciated. I'd like to touch on your point on innovation. you specifically focused on the corporate and its role in innovation. But I'd like to ask you whether you think big corporates are the place for innovation, or is that better placed within smaller startups, given the tech boom, etc. But at the same time, tech companies, make it a bit practical, Uber's reported a profit for the first time in its 11, 12-year history, but its entire business model is different. And ultimately, is the innovation that we're looking for not corporate type of innovation, but social innovation. So, for example, specifically on transport and Uber, yeah, you can have an automated self-driving car. That's great. But you've not solved the actual emission and the planetary degrade, and you're not employing the people. So do you think innovation is better placed in a smaller environment? But that said, again, the venture capital market is controlled by very few defined actors, which leaves out a predominant sector of the market, for example. And I'll say it again, I'll like continue to harp on this point, but there isn't, then it leaves out the large majority. And by the large majority, I mean the continent of Africa.
Yeah. Okay, well, you're asking two questions, and then when you throw in globalization, and it's actually a third one. But the first one I answered a bit yesterday. So I mentioned the pharmaceutical industry study where most of the innovation is coming out of smaller firms, and then the question is, how do they manufacture? I mean, the big pharma, Merck and Pfizer, what they do is they can manufacture. I mean, that's why BioNTech had to use Pfizer. That's for the vaccine. But that's a general proposition that where you have rapidly changing technology, new science, this small firms and often venture-backed firms in high-tech industries have become more the norm. But the question is, what happens to them? I mean, Apple was a small firm, Intel was a small firm. They grow large. And what happens when they grow large? Do they remain innovative? What happens when they acquire other companies? It's a big question for research. And the other question is, who gets to share in the gains? And there is a question of, I called it yesterday, progressive value creation versus predatory value extraction. Basically, how you can actually have innovation and ensure that the most people can, who contributed, share in the gains, and actually then have the government tax away some of the gains in order to, as has been done in welfare states, to increase the standards of living and the productive capabilities, hopefully, of those groups of people who haven't shared in the gains. And hopefully over time, and this is what I'm talking about in terms of the investment triad, you will have, through the action of the investment triad, households and governments and businesses all invest in productive capabilities, have more and more people who are part of that, the group that can actually be paid from the productivity of the companies in which they're working. Then there is a question of how this works out globally. So certainly there has to be a major effort to bring Africa into the global value chains, moving up the global value chains. And we can study how that's happened, particularly in Asia, and how, Taiwan and Hong Kong had much lower per capita incomes in the 1970s than most South American countries, certainly Brazil and Argentina and Chile, and of course had a very different development path. So that has to be understood as well. And one last thing, which I kind of hope I can write an article on this soon, is that what I'm talking about here is, well, okay, economists have always talked about goods and services. I'm talking about goods, things that you can mass produce. But there are all these services. Now, many services get turned into goods, but many services are going to be services. Like you can automate healthcare to some extent, but you're going to still need the services. And years ago, an economist who I like and dislike, William Baumol, wrote about the cost disease, the service and the cost disease. I think that was actually a bad name, because having high quality services should be the goal of a rich society. and actually using the mass production system and the productive part of the economy to fund those services should be the way we raise everybody's standards of living. I mean, what you do in the UK with National Health Service, but we don't do in the US. I mean, the reason we don't have nationalized health service in the United States is because precisely because corporations used to deliver that in the post-World War II decades to white males. And so you didn't worry about the rest of society. And when they stopped being a retain and reinvest companies, what I call the old economy business model, they just said, okay, well, we're not going to jump in and have these services that are available to everybody. And in fact, they fight tooth and nail against it.
Okay, Chase.
So real quick.
Yeah, real quick one because we're running.
Hope you don't mind if I ask a little bit of a provocative question. So, I'm fully convinced that maximizing shareholder value, is bad for inequality, undermines social cohesion, et cetera. But I'm not fully convinced it's always opposed to innovation. And so I guess my question to you is, even as the US has embraced all of these doctrines and institutionalized share buybacks, et cetera, how is it that US firms have remained in certain sectors so incredibly productive and innovative? Is it in spite of doing these things that you claim are so dominant? Or possibly is it that there are certain sectors or types of innovation, perhaps radical innovation, perhaps, high risk, big reward kind of innovation that actually does align sometimes with maximizing shareholder value?
Yeah. Well, I don't know how you could ask such a provocative question in such an unprovocative set of lectures, but anyway. But no, that's a good question. And I've written about, I directed to my book, Sustainable Prosperity in the New Economy, which is basically about the rise of the new economy business model, which also relates to the question of venture-backed firms, et cetera. And I mean, the short answer is I have a framework of the uses of the stock market, which is 5 C's: creation, control, combination, compensation, and cash. And I don't have time to go into what all those are, but they're in some of my books. And they basically, the new economy business model grew up with the stock market, being able to induce venture capital because of a quick IPO on NASDAQ, using cash as a combination currency to do merger and acquisition. It's a compensation currency. And so a company like Cisco, for example, which Maria Carpenter I've studied intensively, which did this in becoming the dominant player in the enterprise networking industry in the 1990s, was highly innovative and had great organizational integration and acquiring other companies. But really, with the stock market being integral, like part of its DNA, if I might say, in the ICT. But what happens then is once that use of the stock market starts breaking down, then they just try to get the stock price up any way they can, and they lose track of the innovation and what might have been something like, for example, stock-based pay, which everybody had at Cisco, sharing out the gains. First of all, at some point there becomes too much of it. I won't go into numbers of companies like Cisco and Microsoft. And so people start leaving and learning starts breaking down. But then the downturn comes and people who made millions actually right down in the organization, there's next to people who now have more experience, but maybe are now with the stock price down. They might have been there in the boom, but their options to invest and they got nothing. And so you have huge disparities within companies. So this creates all kinds of problems, which someone like Bill Gates actually recognized at Microsoft. He started talking in the early 2000s about when the stock market went down, about what a mistake it was to go on the stock market when he did. And the only reason he did it, he didn't need the money because he didn't really have any venture capitalists backing him. He in 1986 went to the stock market is because he'd given everybody stock options in 82 to attract people, and now all the stock options are vesting. And how are you going to actually give them liquidity without going on the stock market? Now you can do that. Actually, SpaceX, which is still private and under Elon Musk, they have things every year they call liquidity events, and they're internal ways in which you can sell the stock that you've exercised from your stock options. So they create an internal market basically to give liquidity and allow people to cash in when you're not going to get to an IPO next year or 10 years from now, even perhaps. But in other companies, the expectation is you get to an IPO very quickly. And like, just the last thing I'll say, like in the pharmaceutical industry is the one industry, the biopharma startups, which raise billions of hundreds of millions and often sometimes billions of dollars on the stock market, not just in IPO, but in secondary issues. But the people who buy those shares don't really care if they ever have a product because they only buy them if the market's liquid. Now, then there's the question is, what do the companies do with that money? Do they just make people rich, or do they actually build successful companies? Owner Toolum and I are now doing a project comparing Moderna and BioNTech, the two mRNA vaccine makers, arguing that Moderna is totally financialized and will not build a great pharma company, where BioNTech in Germany will. And that's our prediction. If we're wrong, then economists can say your model was wrong, and let's go back to the assumptions under the model and debate it.
Okay, we're almost out of time, so I'm going to use chair's privilege here and ask the last question, but there's time for more questions when we get to drinks in Senate House. But Bill, you've done the fantastic service to us, to show and document so carefully exactly what's going on with the financialization, its impact on innovation. And I know you're probably thinking about policy. So I guess the final question would be, what are the steps for policy to try and address some of these issues?
Steps for policy.
Yeah, what measures could?
Well, I mean, in both the predatory value extraction book and then elaborated much more in this small book, Investing in Innovation, which Investing in Innovation I wrote really to look at Biden's policy, which is very regressive in many ways, and some of it stalled because all the stuff to do with families didn't get through the Congress. That's why it's interesting that they said that semiconductor companies that get some of this funds from the Chips and Science Acts have to have daycare centers. I think that was an attempt to get a little bit of that in there. But I go through from the point of view of corporate nationalization. It's not the whole policy agenda, but what they have to do, which is banning buybacks, which should be easy to do. Cease having executive pay be tied to stock price, which is driven by speculation, manipulation, as well as by innovation. And have what we talked about in terms of GM, people who actually matter on the boards, and keep people who are predators off the boards, which is just the opposite of what it is now. Fix the tax systems that are actually rewarding innovation. And then the last thing I end with is invest in collective and cumulative careers. So you need collective and cumulative learning. You have to have collective and cumulative careers. You don't do that anymore largely with one company. And you often do it across continents even. So how do you have policy that actually makes use of, I mean, this is Edith Penrose's question, but on a societal scale, makes use of those unused resources. There are people who get laid off in their 40s and 50s who have all kinds of education, all kinds of experience, are from society's points really valuable unused resources, but no one knows who they are. And they end up working, at a Walmart or something, or just getting a menial job often. And it's a total waste of resources, and it totally disincentivizes, people getting all that education and experience. And that's not even documented, but we know all those people are out there. And so that's a huge policy agenda where business isn't doing it. The government needs to step in.
Yeah, well, thanks very much. And taking that policy agenda forward, I mean, it wouldn't be possible without all of Bill's research and publications on this. So, and also his lectures. So let's thank Bill once again for two really excellent lectures.
Thank you.